and welcome to Money Matters TV. My name is Doug Hepburn with Hepburn Financial Advisors in Phoenixville, Pennsylvania, and I'll be your guest host for today. We offer securities and investment advisory services through Cetera Advisors, a broker-dealer and registered investment advisor, member FINRA SIPC. Cetera is separately owned from any other named entity. I'd like to introduce my co-host, Ken Jordan from Princeton Mortgage. Ken, how are you?
I'm fantastic, Doug. How are you?
Great, thanks. I always ask, tell me something good in your world, but with the rising interest rates and the layoffs we hear in the mortgage industry, I'm not sure that there's a whole lot of good news there. Is there?
We are, well, there's some good news. There is some good news. I will say we are in the toughest season of the toughest cycle that the industry has seen in a long time. And it's there's a lot of people that feel like we're in probably the third or fourth inning of a 9-inning game when we talk about the shift. And there's some optimism in the spring market conversations. But, not to time our show or anything, but, December, January, relatively lean times as it is, and certainly leaner now with the origination volumes dropping to, 25, 26-year lows. Companies are all scrambling to try and figure out how to best weather the storm. And it's been interesting. But there is some good news. We actually saw mortgage rates settle and even come down a little bit for the first time in about 3 or 4 months. Interest rates dropped to levels that we haven't seen since September.
Okay.
So that's good. But who knows? Once the Federal Reserve starts talking again and all kinds of chaos starts to ensue, you never know what the next 90 days is going to bring.
Oh, based on all that talk of seasons, it sounds like it makes sense to work with a seasoned professional.
Always best to work with a seasoned professional. I like the way you work that in there, Doug.
Hey, it just seemed to fit. Well, it's been a crazy market all over the place between, the residential market, the commercial market, the equities and the fixed income markets. There's a lot of volatility out there and people just don't know what to do. And so, it's a little disheartening or disconcerting for some because we'd all love to be able to have a crystal ball and have that opportunity to know, get tomorrow's news today. Mm-hmm. But the reality is, if it weren't for that uncertainty, it wouldn't create opportunity in any market. So you almost have to welcome it.
If you were getting consistent commentary, that would feel better, right? But then you get conflicting commentary and you're like, man, it's true. People, even some really, really smart people just don't know what's going to happen.
Right.
Right. What are you hearing in the equities market?
Well, I think the big driver in a lot of this is, and the questions that people are having are, first off, interest rates are going up. I mean, before that, we've got inflation. So everybody is managing their pocketbook, trying to figure out how they can make ends meet, what to buy, what not to buy. Do we continue to buy now and with the expectation the prices are going to go up? Or do we just sort of cut back? And as a result of that, the Fed's raised interest rates. Mm-hmm. We've seen the fastest increase in interest rates over the past 9 months that we've seen ever. It's kind of unprecedented for the Fed to go and raise rates 75 basis points every time. And so after the last interest rate increase and the Fed's Open Market Committee minutes coming out, it kind of indicated that we would see a slowdown, not a pause, but a slowdown in the rate of increase in interest rates. So the markets were expecting maybe a 50-point increase in the next Open Market Committee meeting. Right now, the Fed's in their quiet period. We're supposed to be getting those minutes next week. But a lot of the economic data that we're seeing is indicating the Fed may have painted itself into a corner and can't really do only 50 basis points. They may be forced to do 75. So we're sort of in an environment where good news is bad news. I mean, because we've all been talking about being in a recession, right?
Mm-hmm.
Or having a recession, or the R word coming sometime soon next year. But which a lot of people would say is bad news. But when you have good news that the economy is strong, it's almost bad for markets because it means that the Fed's just going to raise rates, and nobody wants that.
It's what we've been talking about the last couple episodes too. Is really it's like, the Fed needs to create a situation and to create an environment where we do cool off the economy so that we can cool off inflation at the same time. There's only a handful of ways to pull money out of an economy, and obviously one of them is to raise interest rates, and the other, unfortunately, is the unemployment rate.
Exactly.
And that's the thing we haven't seen. That's ultimately what will impact the real estate market, will impact the mortgage market as well, is the unemployment rate across multiple sectors. The mortgage industry has seen massive layoffs over the last 6 months, but other sectors haven't felt that yet. And I think when they do, I think that's part of their plan.
Yeah. Oh, you're absolutely right. You're absolutely right. Because, as we see, when inflation really gets fixed in the economy is when you see a wage price spiral, meaning people are leaving jobs to go to another place for a higher payout or higher salary. And we've been seeing a lot of that. It's not until either unemployment goes up or people get concerned about their own job security that they stop looking and jumping ship, that you're going to see the wage increases kind of slow down. Now we've talked about I know we talked about this previously. Real wages in comparison to inflation have while wages have been going up, people's ability to save has gone down because wages haven't gone up as much as the rate of inflation, and so people are getting squeezed.
Sure.
The question is whether or not this increase in interest rates, which again it impacts the housing market more than anything up front, is going to have an impact on people's spending, reduce the money supply, and cause inflation to slow down. But it makes me it raises a point, with people now trying to get mortgages.
Mm-hmm.
It seems to me like having credit and being someone who can be underwritten is extremely important. So I'm sure you guys are doing a lot of background checks on your prospects, and you probably don't come up with a lot of people that have poor credit in today's environment. Is that right?
Well, I mean, people with challenge credit, sure, they're there. But you're right. I mean, ultimately, underwriters are looking for the minimal risk. And, when volume is down the way it is, what they call early credit defaults, where, mortgages go belly up, a person stops paying their mortgage early on in the process, those can be extremely detrimental to a mortgage company and their ability to finance. So there is an added layer of quality control that we're seeing over the last 90 days, I think, in response to the fact that those early credit defaults can be so detrimental. So and at the end of the day, as it's been for the last couple of years, your credit will drive your terms, and they have these
Right.
loan level price adjustments at the agency Fannie Freddie level where, borrowing money is more expensive when you have a 640 credit score versus a 780 credit score. It's just the way it is.
And it's funny you mention that because we saw that in 2008. After all these people, had issues with their mortgages, being sold negative amortization mortgages, and over financing real estate. Once all this stuff went on the market, the banks didn't want to lend because they set credit standards so high that nobody could meet them. But it's interesting. I asked that because we got a question from a viewer. In fact, Gary Hellman from Philadelphia asked, can you get a mortgage without a credit score?
That is a good question. And what we've always said in the industry is that having no credit is better than having bad credit. Now, HUD does require the program, FHA does require that, you're not allowed to turn anyone away because they have no credit. So what happens is a lot of lenders look for what they call alternate credit. So if you don't have any credit scores, but you've shown the ability to pay rent that can be documented over the last 12 months, if you have utility bills and other expenses that have been paid and that can be documented over a 12-month period, you can use that alternate credit to qualify. Where folks find themselves in a jam is where what credit they do have is limited, and there could be, one derogatory trade line on the credit report, and that's far different than having no credit. So the answer is yes, with the right lenders in the right circumstances.
So what about those people who just want to go completely off the grid? Are they ever going to be able to, get credit? Because obviously, when you have kids, and your kids have no credit until, and oftentimes when we work with clients with kids who are either in college, we tell them, look, just get a credit card, buy something, pay it off, and don't touch it. That way you've got good credit because you borrowed and paid it back.
So I think that the answer to that, if being off the grid, so to speak, if you want to participate in the societal structures that have been created to help facilitate, home purchases, to help facilitate, growth and building net worth, then certainly you got to kind of play by the rules of the game. So no, I mean, if you are not showing a documentable track record of managing finances, then it's not to say that someone's not going to lend you money, but it does mean that you won't be able to borrow money from the traditional sources of, Fannie, Freddie, FHA, VA. That kind of financing is not going to be available to you.
That makes sense. That makes a lot of sense. Well, again, the big question that's on people's minds is, what's going to happen with interest rates? Because again, for most people, you need credit to buy a house. You need credit if you want to finance your business, whether it's a line of credit for working capital, or if you're financing the purchase of commercial real estate or even machinery. Credit makes the world go round.
Sure.
But the big question is whether or not we're going to have a slowdown in interest rates. And I just wanted to share with you a couple of things that have come across my desk recently. I mean, last week, we found out that the Supply Management's Purchasing Managers Index for services was released, and it was actually better than expectations. So the supply side, the services side of the economy is actually doing well. And the reason they use that index is because they're purchasing managers. They're the ones who are leading transactions. So they're gonna know whether or not they're buying stuff in the future. So it kind of gives you a good read on things. But a lot of people expected us to see a contraction in the services sector, and the services sector, at this point is far bigger than the manufacturing sector in the U.S. economy. So there's a lot of evidence to support the fact that we're not seeing the slowdown that the Fed is anticipating. And as a result, interest rates may stay elevated, and we may even see another 75 basis point increase after this next meeting.
That's a distinct possibility, Doug. I mean, at the end of the day, you'll talk in our industry, you'll talk to folks that say, hey, we think rates are going to come down in the first quarter next year. We think rates are going to come down in the second quarter of next year. But then you go and you look just today, Realtor.com comes out with a with an article where the chief economist for Realtor.com says that rates are going to stay steadily in the mid sevens for 2023 and low 7.1 for 2024. That's not a drop in interest rates. That would actually be, ironically, that would be an increase in interest rates from where we are right this second. And maybe,
probably and a normalization when you consider past history.
Yeah. But here's the thing. If that's the case, I think everybody eventually will adjust to that. Especially with the real estate market. And I imagine in a lot of industries where interest rates are critical, it's about stabilization. It's about how to make business decisions in the 90-day or 60-day landscape. And you can't make those business decisions without knowing what things are going to cost 90 days from today, 120 days from today. So once everybody comes to terms with what the new normal is, then we'll start to see more transactions. We'll start to see more transactions in the economy on the big ticket stuff. We'll start to see sellers come to terms with what the real value of their property is, not these elevated, post-pandemic values. You'll start to see borrowers come to terms with what their money buys them, and they'll start to shop within their means. And I think that, until that happens, we're just going to have that kind of that gridlock in some industries. But others, they're going to need to increase rates if some of these other industries are not cooling off the way they anticipated.
Yeah, no, that's a very important point. It's not, if you don't have some sort of stability, it's difficult to do any kind of forecasting and to plan. And virtually all successful businesses have some sort of strategic plan, and they want to plan with as few variables as possible. There's going to be some variables, but when stuff is all over the map, it makes it really difficult to plan.
I mean, how's this for difficult to plan? Highly credible, right? Realtor.com economists say that they expect values to continue to rise at a much slower, at a very slight pace over the course of next year. Then you have, it was Barclays forecasted a 10% depreciation rate in 2023, followed by a 2024 4% depreciation rate. Moody's put it out that they think there's going to be a 4% depreciation rate on residential real estate in 2023. And then CoreLogic just recently changed their prediction to a 4% increase in values in 2023. So again, how do you make plans? How do you make strategic 12-month decisions when some of the smartest people in the industry are playing tug of war with their predictions?
Or they're all over the map, and you would think that they're making decisions based on the same information, right? Unless somebody else has a bit of information that is either non-public or is leading in some way, and that they're able to get to it before everybody else. You would think that they'd all come up with a similar forecast. So when you have that disparity of projections, it really does raise the flag of uncertainty and make people wonder, how can we plan in an environment like this?
The good news with residential real estate is no one should be looking at 12-month decisions or 6-month decisions. Really, the decisions you need to make are the best decision you can make in the moment. And these are all long-term decisions, right? I mean, unless you're looking to flip or speculate in the real estate market, which is highly risky anyway, and hey, it is what it is, but if you're buying a home and you're going to live in it for the next 10 years or the next 7 years, by and large, you'll be okay. There's some unlucky folks that go, from peak to peak or trough to trough, and that's no fun. But if you're looking to buy your house and you're looking to be in that home for the long haul, then really it's just a matter of making a good decision on where you want to live, what you want that house to, what you want your lifestyle to be in that house, and then you'll have opportunities to refinance potentially down the road if rates are high, and ultimately real estate historically goes up. So
exactly. Well, there's only so much land on the planet.
Correct.
And pretty soon it's all going to get developed. or have
Well,
some kind of
protected by the
interest.
federal
Or
government, one or the
protected.
other.
Exactly. Exactly. Now you mentioned in our prelude to the show
Mhm.
that there were some interesting and unique products out there that people are utilizing now that may be of interest to some of our viewers.
So we're seeing in light of the environment we're in, with values being high, home buyers not necessarily being priced out of the market from a technical standpoint, but
Right.
certainly being priced out of the market from an expectation standpoint, from a budgetary standpoint. They know what they can afford, but they are not willing to go that high, and that's understandable. That's perfectly human nature, and that's understandable. So there's a new. And it's not new, but there's been conversations, a lot of conversations around something called a 2-1 buy down, which basically allows the borrower to utilize seller concessions to step into their mortgage. And what does that mean?
Okay.
Well, ultimately, if the interest rate today is, let's say, 6.875%, just pick a number.
Right.
Well, a 2-1 buy down would allow the borrower to essentially lower their payment to an effective interest rate of 4.875% year one,
Okay.
5.875% year two, and then 6.875% for years 3 through 30. Now, it doesn't sound like a lot, but on a $525,000 property with 10% down, I just ran this scenario this morning, it saves the buyer about $661 per month in the first year.
Wow.
And roughly $300 per month in the second year. Now, it's not free money by any means. The buy down is funded by the seller through something called concessions. So if you're buying it for $525 and you utilize this program, you would need to ask the seller for, let's say, $12,000 in a seller's assist, and that money gets set aside to subsidize your payment over that period of time. Now, you could ask for a seller assist of $12,000 and do whatever you want with it. You can put it towards other closing costs. You can decrease the amount of money you need to go to the settlement table with. All of that is fine and good. But from a budgetary standpoint, it's a really cool way to kind of keep that payment low in year one and allow you to step into that mortgage. Now, if rates go down and you still have excess buy down funds that you haven't used and you're within that 2-year window, you can actually refinance and utilize the excess funds towards the refinance, which is great. If the rates go up, that 6.875 years 3 through 30, it's going to look pretty darn good,
Yeah.
So it's a really cool way for buyers, especially younger buyers, who are the ones who are being the most having the most difficult time, but also they're the ones with the most upward mobility in their income. They're the ones that really could look at this as a solution to the current higher prices, where effectively they could afford to get into the house year one, year two, but the ceiling is capped. It's capped at what the rate would have been today anyway.
So
It's been pretty popular.
That raises a couple of questions on my end. If you got seller assist, does that mean that the actual sale price of the house is lower than what they put it on the market for?
It does not mean that the actual sale price of the house is lower.
Okay, the reason I ask is, so now, in exchange for getting this seller assist, you're still, buying the house at whatever it was on the market, and your real estate taxes are going to be pegged at that.
Right? Well, real estate taxes in our area are going to be pegged on the assessment.
Well, the steb rate, yeah.
Right. So it's not going to have an immediate impact on real estate taxes, and we're not talking about massive amounts of money. But to your point, though, if you were to ask for, instead of a $12,000 assist in this scenario of $525,000, you could go in and ask and offer the seller $512,000, $12,500, and effectively, it's the same net number to the seller, right?
Right.
So it's a sale price minus a concession, and that's what the seller would have accepted. But the reality is, going in at a price that's $12,000 below asking price is only going to have a $40 to $60 per month impact on your payment versus a $600 a month impact on your payment in year one. Now, in the long run, if you look at anything over 30 years, certainly it would change the strategy. But if your thinking rates are going to come down, you'll be able to refinance out of that loan, or you don't think you're going to be in the house for 30 years. Those are two scenarios that are very, very possible. Then that's where the buy down becomes more effective. Now, if there's multiple sellers assist, we have seen situations in the past where as property values are coming down and the market starts to open up, the seller concessions can impact the appraisal grid, which could impact the next person that buys in that neighborhood and what the max value is and the collateral analysis is on their property. But the sale price is the sale price, and then the concessions.
So really, this $12,000 concession, seller concession, is basically going into an escrow account and going to subsidize that first 2 years of mortgage payments.
Correct. It's not free money. It's just a way to structure the transaction so that the borrowers can have an easier transition.
Right. That makes a lot of sense. Well, when you consider all the factors involved, current interest rates, lack of housing out there, available housing for people to buy, that makes a lot of sense. One of the things that, certainly most of our clients are established. They have their personal residence, and in many cases have paid them down or off. But when you're looking at, when I do talk to younger people, one of the things that I emphasize to them is, first off, when you're buying a house, you're not buying it because it's an investment. You're buying it to put a roof over your head and to put your kids through school. And, and if you end up turning a profit on it at the end, that's great. But don't go into it thinking that you're going to hit a home run. When you look at the numbers, buying a house, owning real estate versus renting a single family household or even an apartment, the difference is huge from a cash flow perspective, generally speaking, because now, granted, if you're talking about a very large and expensive house versus an apartment, there's not going to be any gain there. But the reality is, when you look at something comparable, you can usually get more real estate with a house. You have more control over it. Yeah, you have maintenance, but you're better off owning the real estate and participating in that as opposed to being in an apartment where you're constantly facing rent escalation and have no equity interest in it. So that's a great idea.
Yeah, there's an old saying in our business that you're always paying someone's mortgage. It's either yours or your landlord's.
That's funny. Yeah, that's true. That's very true. Well, hopefully we'll find out next week where the Fed's going to be and if we're going to be if we're going to see 50 basis points or 75 basis points as a hike. I know a lot of people have talked about how this affects the Treasury market, and some investment managers have already said that this is actually a great opportunity, a great time to move towards longer dated treasuries, longer dated fixed income instruments, because at some point, when the economy slows down, it doesn't seem like Congress is going to be willing to do a whole lot of fiscal stimulus, which leaves the Federal Reserve as the only source of any kind of stimulus, monetary stimulus, to reduce interest rates and get the economy going again. The real question is whether or not, we've seen the peak and and if we hit a soft landing.
Only time will tell.
That's really the $64,000 question. Well, it was great talking to you today. Hopefully you've enjoyed our program. Our guest next time is going to be Audrey Greenberg for the Center of Breakthrough Medicines. So tune in for that. And again, thanks for watching Money Matters TV, where your money matters.